Pull up the national debt clock in Times Square, or log onto the U.S. Treasury's website, and you'll encounter a figure so vast it barely registers as real. Right now, it's barreling past $35 trillion and accelerating toward $38 trillion. To make that concrete, if you laid $38 trillion in single-dollar bills end to end, the chain would wrap around the earth more than 145,000 times. For years, the political class assured us this was nothing to worry about. Debt doesn't matter, they said, because we essentially owe it to ourselves. As long as GDP grows, the burden stays manageable. They treated the national debt like a high score on an arcade machine, alarming on the surface, harmless underneath. But in 2024, the calculus shifted. We have crossed into a new fiscal reality where the debt is no longer a theoretical concern on a spreadsheet. It has become an active drain on the lifeblood of the federal government. For the first time in the nation's history, Washington spends more on interest payments to bondholders than it spends on the entire U.S. military. Let that land. We are paying more to service the financial obligations of the past than to defend the country in the present. Interest payments now rival what we spend on the entire Medicaid program, and the annual interest bill is closing in on $1 trillion. This dynamic sets in motion what economists call a debt spiral. In your personal finances, excessive debt has a simple cure. Cut back, stop dining out, cancel subscriptions, tighten the belt. Governments don't have that luxury. A massive share of federal spending is legally mandated. Social Security and Medicare are promises etched into law made to tens of millions of retirees who built their lives around them. No politician can touch those checks without facing immediate electoral annihilation. So spending can't be cut in any meaningful way. Instead, to cover the interest on last year's debt, the Treasury must issue new debt. It borrows on a new credit card to cover the minimum payment on the old one. That increases the total balance, which increases next year's interest bill, which demands even more borrowing. It is a self-reinforcing loop that expands exponentially with no natural ceiling. So what are the options? Historically, there are three ways a sovereign government can escape a debt burden of this scale. Two of them are politically off the table. Option one is austerity, dramatic tax hikes paired with equally dramatic spending cuts. To actually balance the budget, the government would need to either roughly double income taxes across the board or eliminate entire cabinet departments, including the military. Any congressman who campaigns on cutting Social Security benefits by a third will not hold office past the next election. Any presidential candidate proposing a 70% top marginal tax rate will lose in a landslide. Government spending has become so deeply embedded in the American economy that abruptly withdrawing it would trigger a depression of historic proportions. Austerity is a dead letter. Option two is explicit default, walking up to a microphone and announcing that the United States will not honor its obligations. Argentina has done it, Russia has done it. But for the issuer of the world's reserve currency, it would be something categorically different. Every bank on earth, every pension fund, every trade settlement denominated in dollars rests on a single foundational assumption, that U.S. Treasury bonds carry zero default risk. The moment Washington repudiates that debt, the global financial architecture collapses. Wire transfers freeze, credit systems seize, international trade grinds to a halt overnight. Explicit default is the financial equivalent of mutually assured destruction. It is not a serious option. That leaves option three, the quiet option. The option chosen by every overstretched empire from ancient Rome to Weimar Germany to post-war Britain. You don't refuse to repay your creditors, you repay every single cent, but you repay it in currency that has been quietly devalued since the day you borrowed it. You print the difference. This is the soft default, and it is not a conspiracy theory. It is the de facto policy of the United States government, largely unspoken, but operationally very real. It functions as a mechanism of financial repression, a deliberate structural transfer of purchasing power from the people who saved to the government that spent. The mechanism is straightforward. Keep the interest rate paid on government debt below the prevailing inflation rate. If Washington owes $30 trillion and inflation runs at 5%, the real value of that debt shrinks by $1.5 trillion in a single year, without passing a single tax bill or eliminating a single program. Bondholders are paid in full. They just find that those dollars buy considerably less bread and considerably less real estate than they did at issuance. The loss is disguised as a supply chain disruption, or described as transitory. The word theft never appears in any official statement. What makes this era distinct from previous cycles is a structural shift in the relationship between the Federal Reserve and the Treasury Department, a shift economists call fiscal dominance. For 4 decades, the Fed operated with meaningful meaningful independence. Its mandate was to protect the purchasing power of the dollar, and if that meant hiking interest rates until the economy bled, so be it. That era is functionally over. The debt load has grown so enormous that the Fed cannot raise rates aggressively enough to truly suppress inflation, because doing so would destroy the federal budget. If rates return to the levels of the early 1980s, around 10%, annual interest payments on $38 trillion would exceed $3.8 trillion, surpassing the entire federal tax revenue of the United States. The government would become insolvent within months. The Fed knows this. So instead of fighting inflation with full force, it tolerates it. It keeps rates structurally lower than they should be. It has become, in effect, a financing arm of the Treasury, its independence eroding year by year. This is the slow motion crisis. There is no single dramatic collapse. The debt continues climbing, past $40 trillion, past $50 trillion, while the dollar continues losing ground. The government is running a calculated gamble. Inflate the debt away faster than financial markets can organize a coherent response. Threading that needle requires sustained inflation in the 4 to 5% range over a full decade. That sounds modest. The compounding effect is not. At 5% annual inflation, the purchasing power of your savings is cut in half within 14 years. That is not an accident. That is the plan. Now let's examine the specific machinery being used to execute it, the captive buyer. In a genuine free market, a borrower with $38 trillion in debt and no credible plan for repayment would face rising interest rates as lenders demanded compensation for the risk. The U.S. government cannot afford that outcome, so it manufactures its own demand through regulation. Under frameworks like Basel III and Dodd-Frank, banks, insurance companies, and pension funds are legally required to hold U.S. Treasury bonds as high-quality liquid assets to satisfy their regulatory capital requirements. It is irrelevant whether those bonds offer real returns. Compliance is mandatory. Your pension fund is not holding government debt because it represents sound investment strategy. It is holding it because the alternative is losing its operating license. The broken compass. The Consumer Price Index, the official measure of inflation, is also the index used to calculate cost of living adjustments for Social Security and the payouts on inflation-protected Treasury securities. The government, therefore, has a direct financial incentive, measured in hundreds of billions of dollars annually, to keep that number as low as possible. Since the 1980s, the methodology for computing CPI has been systematically revised in ways that consistently produce lower readings. Substitution bias replaced fixed basket comparisons with a shifting basket. If steak becomes expensive, the model assumes you switch to hamburger and counts that as no meaningful loss in living standard. Hedonic adjustments reframe price increases as quality improvements. A car that costs $5,000 more than last year's model doesn't represent inflation, the logic goes, if it also has better safety features. Taken together, independent economists estimate that if the 1980 methodology were applied today, official inflation figures would be roughly double what the government currently reports. The CPI has been quietly engineered into a budget management tool. When foreign governments, historically major purchasers of U.S. debt like China and Japan, began reducing their treasury holdings, a demand gap opened. The Federal Reserve stepped in as buyer of last resort, creating new dollars to purchase bonds the open market no longer wanted. This is quantitative easing. The effect is to hold yields artificially low, keeping the government's interest bill manageable while simultaneously flooding the financial system with freshly created currency. Asset prices surge, stocks climb, real estate values rise. Your 401k balance looks impressive on the dashboard, but that number is denominated in dollars that buy progressively less each passing year. The wealth is nominal, not real. The government has effectively diluted your share of the economy to pay for its own obligations. Here is the distribution problem at the core of this entire mechanism. When the Federal Reserve injects $1 trillion into the economy, it does not distribute that money uniformly. It buys bonds directly from large financial institutions, major banks, asset managers, investment firms. These entities receive the new money first, before any price increases have occurred. They deploy it immediately into stocks, real estate, and other productive assets. By the time that liquidity filters through the economy into wages and consumer prices, the inflationary effects have already materialized. The asset-owning class profits at pre-inflation prices. The wage-earning class absorbs the inflation without having received the asset appreciation. This is the Cantillon Effect, first described by the 18th century economist Richard Cantillon, and it is the precise mechanism driving today's K-shaped economy. Since 2008, the wealthiest 10% have seen their net worth worth expand dramatically, largely because the Fed has been inflating the value of their holdings. The bottom 90%, whose wealth is primarily denominated in wages and cash savings, have watched their purchasing power steadily deteriorate. The national debt is being liquidated on the backs of the American middle class. This reality demands a fundamental reassessment of conventional financial wisdom. The 60-40 portfolio, 60% stocks, 40% bonds, was designed for a monetary environment where cash preserved its value and government bonds offered a genuine real return. In a world of fiscal dominance and persistent negative real rates, that framework becomes a mechanism for guaranteed wealth destruction. Holding cash means certain loss. Holding government bonds means certain loss of purchasing power. The rational response, if you want to simply hold your ground financially, is to own assets that cannot be inflated away. The government has effectively converted the entire savings landscape into a forced speculation environment where taking risk is no longer optional. Prudence has been made dangerous by design. The final instrument in this toolkit has not yet been fully deployed, but its construction is well underway. Central bank digital currencies, or CBDCs, represent the logical endpoint of the current trajectory. Physical cash, for all its inconveniences, provides one critical function. It allows individuals to exit the banking system. If the Fed imposes negative interest rates, charging you to hold money, you can withdraw cash and sidestep the penalty. That exit disappears with a purely digital currency. A CBDC grants the central bank total, granular control over monetary behavior. It enables negative rates applied directly to every account balance. It enables expiration dates on money, forcing spending within defined windows or forfeiting the funds entirely. It enables transaction-level restrictions, limiting what categories of goods or services your digital currency can purchase. This is not speculative. China has been piloting these exact features with its digital yuan for years. The digital dollar is not primarily a payments innovation. It is a debt management instrument, one that eliminates every remaining exit ramp from the financial repression system. The conclusion is not pleasant, but it is clear. The United States will not default in any conventional sense. The $38 trillion will never be repaid in the real purchasing power it represents today. Instead, the debt will be quietly liquidated through sustained, managed inflation over the coming decade. Those who hold wealth in scarce, tangible, or productive assets, real estate, precious metals, equity in profitable businesses, assets with finite supply, will maintain and potentially grow their purchasing power. Those who hold wealth in cash, savings accounts, or government bonds will serve as the silent donors financing the reduction of the national debt. The American formula of earning steadily, saving conservatively, and trusting institutions to preserve that value has been structurally dismantled. We are now in an era of asset survival, where the foundational question is no longer how much you have saved, but what form that savings takes. And history suggests that when the quiet methods prove insufficient, governments have shown a willingness to stop being quiet altogether. In 1933, Franklin Roosevelt signed Executive Order 6102, criminalizing private gold ownership and compelling every American citizen to surrender their holdings to the federal government, under penalty of 10 years in federal prison. In the next installment, we will examine that episode in full, the prosecutions that followed, the legal exemptions that protected the wealthy, and the constitutional framework that remains in place today, the same framework that, under a declared national emergency, could lawfully extend to Bitcoin, physical gold, and retirement accounts. If you believe your assets are secure, you need to understand what the law actually says. Subscribe so you don't miss it.